Good afternoon and welcome to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita, Khemka. Well, turning out to be a freaky Friday. Right from the start, we've seen the markets being fairly under pressure. In fact, under intense pressure, so to say, because we've seen the Nifty clocking in cuts of somewhere around 240, 250 points at the start. But right now, we are at the low point of the day. 312 points, knocked off from the Nifty. In fact, we are below that crucial level of 25,500. That was a very, very crucial support zone that was being flagged by technical experts as well, and we have broken below that level. Not by a wide margin, but still we are at the low point of the day. And Friday the 13th really turning out to be a freaky one for the market, and also the fact that tomorrow happens to be Valentine's Day. I think markets have taken the color red pretty seriously, which is why all we can see across the screen is deep red, and that seems to be the color of the season. And of course, markets latching on to that color as well. But the cut across the broader end of the markets is much more steeper. If you look at the Midcap index, that's now plummeted 1.5%. In fact, even over 1.5% cut coming in on the Nifty Midcap index. Look at the advanced decline ratio. That's almost at 1:4. At the start of the session, it was even worse. It was at 1:6 or something. Some improvement came through, but I think right now what we are seeing is the breadth once again worsening. Only 650 advances to 2,300 declines. So that's the kind of weakness we are seeing in the broader end of the market, and that would mean that portfolios aren't looking all that healthy, and we are seeing some sharp cuts coming through. Especially when it comes to the broader end of the markets. Now inching towards that 2% cut mark on the Nifty Midcap Index. It's an over 1,000-point cut on the Nifty Midcap Index. Of course, when you talk about sectors, how can one not talk about IT? Because we've seen a third straight day of sell-off coming in. But the good part is that the IT index has staged a very good recovery from the day's low. At the start of the session, we were seeing a 4% cut on the Nifty IT index. As of now, the Nifty IT index is down just 1.5%. So it has made a very smart recovery of 4% from the day's low. Although one may argue that it is still in the red, but it seems that value buying is emerging when it comes to the beaten down IT names, because the likes of Infosys, TCS, all of these stocks have staged a recovery of somewhere around 4% each from the day's low. In fact, if you look at the IT laggards, Persistent Systems has managed to edge back into the green. And the stocks like Coforge that were clocking in losses of somewhere around 6-7% at the open are now down 4%, with TCS down just 2% and Infosys down just 1%. In fact, Tech Mahindra also came into the green around midday or so, but it has once again slipped into the red. But nevertheless, these stocks have come off the day's low pretty significantly. That really shows that there is still buying appetite when it comes to IT names. But the other big sector that's in fact dragging the market down today is the metal index. We saw gold, silver prices coming off last night, right? With gold prices slipping below the $5,000 per ounce mark, right? So that's also playing out on the metal index. We've got quite a few laggards there as well. Hindalco, of course, down 6%. Numbers came out. There was pressure when it comes to the US business. Although India business has done well, but the stock is down almost 6%. Nalco is down 5.5%. Hindustan Zinc down 5%. Hindustan Copper down 5%. So, metals as a pocket has been fairly volatile, moving in tandem with what the global prices have been doing. So this Friday, we are seeing pressure coming through on metals because of the volatility in the global prices. Aside of that, real estate pack also looking fairly wobbly, 2% down. Energy down 2%. FMCG, that's also down almost 2%. Just want to point out, on a week-to-date basis, the Nifty IT index has pared some of the losses. In the first half, I was checking how much the Nifty IT index had lost for the week. We were seeing an 11% cut on the screen. But given the fact that we've seen a good recovery come through from the low point of the day, for the week, the IT index is down 8.5%. Still, that's a big cut coming, given the fact that IT forms such a heavy weight or such a large part of the Nifty 50 index as well, and that has of course dragged the index below 25,500. But what's done well this week are the likes of PSU banks. That index is up 3%, autos up 2.5%, Pharma has also managed to clock in gains, and the Nifty Bank Index although saw just a 0.3% kind of a gain for the week, but one has to say that the Nifty Bank has showed resilience throughout the week if you compare it to the benchmarks. For the week, the Nifty, by the way, is down almost 0.8%, although the broader end of the markets have fared much better if you compare it to the benchmark indices. So all in all, that's the texture of the market this Friday, turning out to be a freaky one. Aside of Hindalco, HUL, Eternal, these are some of the consumption names that are have been witnessing selling pressure. Aside of that, you have ONGC reacting to numbers down 3%. Wipro, TCS, they've all paired the losses, so they're down just about 2% apiece. On the flip side, handful of gainers. I mean, you can count the number of gainers on Nifty today, just about 5-6 of them. Bajaj Finance, the stock has been doing well in a week setup as well, and today as well, top Nifty gainer. Eicher Motors, on the back of numbers, I think this is the third or fourth straight session of gains for Eicher Motors. SBI twins, SBI and SBI Life are doing well, and Apollo Hospitals, Cipla from the pharma pack, that's managing to hold out in a weak market. But on that note, let's bring on board our guest for today, waiting very patiently, Ashutosh Mishra, Head Research Institutional Equity at Ashika Stock Broking. Ashutosh, first of all, like to apologize to you for such a long market check, but it does warrant, given the kind of weakness that we are witnessing in the market. My first question really, IT, that's been the talking point. Third straight day of weakness, although we've seen some bit of buying emerge at lower levels. So what's your sense? Do you think the sell-off that we have seen thus far, 8.5% cut this week, do you think that's overdone? Do you think it's just a hype because, AI disruption, whatever, comes through, would take some more time to play out, and investors are, taking recourse to panic selling? What's your sense? Do you see merit in buying at these levels?
Thank you, Nandita, for calling me on this show. For IT, we clearly see that there will be some more pain coming in, especially the clarity is not there. No one knows how the AI things will pan out. I was reading some of the policy holders to some of the IT strategists today morning, and they are saying that IT and software both are will be embedded together and no will perform together rather than one killing each other, no others. So when we look from that perspective, we clearly see that no things will be not as bad as what market is thinking at this point of time. But when we look at current market scenario, market is not ready to adjust any negative. If any stocks or sector have any negatives, market is punishing it hard, and that's what is getting reflected in the IT sector because the uncertainty over the business outlook, uncertainty over the earning is very clear at this point of time, and the market is not ready to adjust that, and that's getting reflected in the sharp cut in the IT stocks in this week. A lot of news is coming on the AI front. Many of them may not be true in the future, but at this point of time, those things will continue to have its negative impact on IT sector as a whole.
Okay, expect more pain. But how are you looking at the sector as a whole? Do you think, given the kind of correction we've seen, from a valuation standpoint, it makes sense to get in now, or would you be concerned about the kind of market cap erosion these companies have seen, and the kind of PE multiple shave off that you've seen? Would you be concerned about that? How would you really look at it from an investment perspective?
So, from the investment perspective, if suppose we are finding some IT product company, then probably that may be a good area to focus first on. IT services, we still need to understand what will be the impact on their revenue with the launch of different AI models and its impact. So. The business model will be get disrupted marginally, but it will not have very great impact. I will wait for another 10-15 days out there to make my mind where things will move out. At this point of time, I will not ask to add up the IT part of it because the clarity is not there, and clarity will take some time to come up because these are not the news and other thing. These are the technology which is developing at this point of time, and the clarity on that will take some time to emerge. So for that duration, it's better that we remain on the sideline, and once the clarity emerge, and then take the position. If someone really interested, then go for some of the IT products company.
Okay.
They are relatively better placed.
Okay. Any names on that front, Ashutosh?
See, like no, we don't want to give the name at this point of time. I'm also just working around that part of it, but we can look
Hmm.
somewhat like persistence, although not IT product, but within a whole IT ecosystem, it is a bit up in the scale. They have more of engineering service out there, so that's one part of it. If you look at some smaller companies who have more revenue coming from the products revenue product division, those will be the beneficiary out there.
Hmm. Okay, all right. IT products, focusing on that instead of IT services. But, of course, India lacks pure play AI names, right? But NetWeb is one company when you talk about AI in particular, right? Would it make sense to look at names like NetWeb at this juncture?
So yes, we really lag on no pure play AI companies out there, and there is no discussion at this point of time that there will be no anything on a, pure play IT company, pure play AI play at this point of time. And really, the few of the company which market is playing out more of a real estate to some of the infrastructure supporting company for the AI at this point of time. We don't have
Hmm.
as such on listed spaces. We have a lot of company on unlisted space which is there in the data center and AI part of it, but in a listed space we don't have much to play. Indian IT is predominantly dominated by the service part of it, and that's why this pain is getting reflected out there. And in the next year or two, we will find some good listing coming in that part of it. But at this point of time, we don't have. No, we can say NetWeb. We can play here and there some story, but it's not pure play AI story at this point of time on a listed space. And when we
Okay,
look at
that's the
relative
view.
performance, there are
But
other
hold that
sectors.
thought. Sure.
Yeah. Yeah.
Hmm.
So when we
Go
look
on.
at others, there are opportunity in other sectors. So it's better focused our energy and other thing on other sector.
Hmm. Sure, sure. We'll, focusing on other sectors as well. But I just want to play out, an excerpt of a conversation we had with another, fund manager in the morning, and we asked him about his view on the IT space. Sandeep Agarwal of Sovilo Investment Managers. We asked him whether or not AI poses a serious threat to business models of traditional IT services, and whether or not this sell-off is actually an opportunity to buy. Well, this is what he had to say. Let's listen into him first, and then we'll come back and talk about other sectors as well. Take a listen.
This Friday the 13th, this has come true. It's actually feeling like Friday the 13th when you're talking about technology, right? What's going on, do you think? Let's start with the global picture. This whole absolute worry that AI is going to completely break software company business models. What have you made of all the noise around it?
Hey, hi, good morning, and thanks for having me on the show and the good preamble. But so let me put it this way, So what is happening is that, if you see after 2003, the hardware cycle has not kicked in. And hardware cycle has actually kicked in after 2022. So that is the reason you are seeing all these GPU sales going up, NVIDIA and all. And all numbers are there. So you can see that, like they're from zero to like 100. That is the kind of growth we have seen. So I think this hardware cycle will continue for some more time. So there'll be good time for hardware, followed by a good decent time for even software services. The reason is that we will have to just reskill our workforce and redeploy. So there will be a pause of 3-4 quarters, which has always been there in the previous disruptive cycle. But this time we have an additional challenge that the efforts will get cut by 20-30% at least when they come for renegotiation. And hence, every year if you assume 20% coming for renewal, 20% cut in effort, so we are at 15-16% kind. So we are losing 4-5% on the overall revenue growth. Even if we bring in 10% new growth, we will be net 5-6% growth. So this industry will have a lower growth for some time. But I am totally, not at all of the view that we will have an impact on the economy, will have impact on the job and all those things. I think those cascading effect will not happen. But yes, we are in for a lower growth for a longer time in the sector. And the worst get impacted will be the software, because they are broadly annual renewals. So whenever they come for renewal, there will be massive slide there. So, and that is the way we have seen the impact on the stock prices also. The hardwares have done phenomenally well. The softwares have been worst hit, and the software services are hit more not because of the growth or crack in business model, but because of the multiple which we are assigning, because everyone now has started building in a lower growth for a longer time. So I think this is what is happening on the overall space.
Yeah, the problem is that, Sandeep, I mean, how much lower growth? Because over the last, I think several quarters, last couple of years, I mean, we've been struggling with 0% to 2-3% in a good quarter, that kind of growth rates for our large cap companies. So now when you say lower growth, the worry is degrowth, that they'll start losing business very rapidly. Is that a valid worry?
So let me be very clear. We will not see a decline in revenues for most of the IT companies anytime in next 3-4 years, in my view. What we will see is that lower growth for long. So basically, large caps will do, let's say, 5-6% positive growth. So EPS growth will be maybe 1% higher, 1.5% higher because of the currency and all. So we are looking at 5-6% kind of revenue growth, 6-7% kind of EPS growth for the large cap. For the mid cap, I would put that number at 10-12% revenue growth and 13%, 14% kind of EPS growth. And the small caps will be also similar. But if you see the multiples, like, the large caps are still at 18-20 times, the mid caps are at 30-40 times, and the small caps are somewhere in between. So I think, at least as a fund manager running my own fund, I will not be comfortable assigning those kind of multiple. And I am very honest, upfront, and disclaimer. Last year we sold everything. I believe that was the peak, and we sold everything in tech. We have one or two very small position in AI related stocks because there are very few listed ones. And other than that, we are almost zero in tech since last year. And I believe that, still the time has not come where I will be excited to buy. I will give not more than 12-13 times multiple to the large cap, and not more than 15-16 times to the mid cap, and similar to small cap. And I think there is a long way to go there. So we will wait for our turn on that.
Okay, so I mean, you're not convinced. You sold out all your tech. A lot of the mid-cap companies, like Coforge, for instance, some of them had managed to buck this weakness when Coforge was a company that was still managing 30% kind of growth rates up until a couple of quarters back. Now, will they also be impacted? Then there was this whole ER&D play in the market for a couple of years. Those companies did better than the large cap IT services companies. So, are there any of these safe haven pockets left at all? Or you think none of these companies will also manage to kind of survive the storm?
No, so definitely Coforge has been an outlier. Since when I was covering the stock, the management has done an excellent job. But remember that base have gone up substantially. So there is a mathematics, there is a business model. So mathematically, as you go up in size, it is very tough unless you are the big tech like Google, Alphabet, and others, where the business models are totally different. It is very hard to grow the services business and a higher base at the same rate. So definitely, the mid caps, what we call mid cap today, maybe 5 years back, they were of the size of the large cap. So those companies definitely will not see 30% growth. I think the growth will be more normalized to 12-13%, 14%, and hence the multiples have to correct. Having on the question on.
All right, that was Sandeep Agarwal of Sovilo Investment Managers with his take on IT. Enough said about IT. Let's, in fact, put the spotlight on other sectors as well. Ashutosh, talk about metals as well. This is one pocket that has been extremely volatile. And, we've seen globally gold and silver prices turning volatile. One day, you see a big crash come through, especially for silver. And then next day, you see prices again moving up. So, in fact, if you look at, the metal prices, the metal stocks, they've done extremely well last year as well. And this year as well, they've fared pretty well till now. Would you say that the kind of volatility we are witnessing, it actually warrants taking some profits off the table at the current juncture, be it ferrous, non-ferrous, or the entire metal universe?
Yeah, I think so. It's better to take some profit off the table at this point of time. Like we are getting a very different set of news in the metal space. Like yesterday, we got that there will be some treaty between Russia and the US, and that will have a negative impact on the way whole global metal market, especially precious metal, as well as some of the important non-precious metal will perform. So and then whole market reacted totally in different way. Gold, silver to copper and aluminum. Everyone has its own negative reactions coming in. That the prices will be not as high as what people are expecting, especially because of the very high level of geopolitical tension. So it's better to take some profit off at this point of time in this sector. But if you look from a medium term perspective, this sector is still remain no in a bit of a uptrending market itself. More clarity will emerge in the coming days. But at the same time, we also need to understand that next 15 days, Chinese market will be closed because of no new their lunar holiday. So the activity in the metal market will be a very low from China end. So that also we need to keep in mind, because normally volatility increase very high because of absence of Chinese trader in the market out there. So keeping that in mind is better in this current period to take some profit off from the metal sector.
Okay, time to take some profits off the table when it comes to the metal sector. But there's one pocket that's shown a lot of resilience. That's the entire banking universe. PSU banks, of course, after the kind of numbers we've had from SBI, they've also hiked their credit growth guidance. They've maintained their margin guidance at 3%. Is this one of the safest pockets to be in right now? And what do you really like within the BFSI space?
Purely, the BFSI whole space is in a very positive territory at this point of time, and given the way whole things is panning out, and this is more of a domestic focused industry. So from that perspective, when we look at FY27 looks very good for the banking sector as a whole. We have almost done with the rate cycle, and from that perspective, when we look at there will be relatively less pressure on the NIMs for the bank in FY27, and that's why our focus will be on a growth. When we focus on a growth, we clearly find that public sector banks are doing much better on the growth front compared to the large private sector banks. And another segment which are doing really good is that is small and mid-size banks. There they are again delivering good on growth front. So it's better to be on a public sector banks than a small size bank, something like Karur Vysya, South Indian banks. So South Indian, there is some other issues of the management changes, other part of it, but Karur Vysya is a good play to be from that. Federal Bank is another good play from that segment. DCB.
Okay. Stick to the PSU banking lot, and the mid and small caps, would actually find favor, according to Ashutosh. Ashutosh, one last word. Any other pockets within the mid-cap universe that you like, especially after looking at the earnings? Because a lot of experts are of the view that 2026 will see a recovery in mid and small caps. Would you expect that to come through? And if yes, how should you be positioned to play out that recovery?
What we have seen is that we have entered into 2 large trade deal, and there will be few more trade deal India will be entering into the next few months. If you look from that perspective and budgetary support also, I clearly see that some of the manufacturing sector, especially if suppose we like to see last year AC season was not very good summer. This was not very good summer. This year we expect this segment AC segment to be doing good. We expect some of the manufacturing to be doing quite well. We expect again some of the pharma. A lot of hangover was there, especially from the US side, that there will be, because of absence of India-US trade deal, there will be more levy. If that is getting settled, then clearly pharma will also be on the focus. So some of these sectors are there where clearly things looks much more positive compared to the other part of the market. And textile too.
Okay.
Because in textile again.
Textiles as well. All right. Sure. Of course, after the India-US trade deal and India-EU trade deal, textiles have been buzzing, although there have been some hiccups post the Bangladesh-US trade deal. We'll have that discussion later sometime, Ashutosh. I would like to, of course, I would like to have this conversation with you again sometime when we can touch upon why or the case for investment when it comes to textile names. But would like to thank you on that note for joining in. Always a pleasure. Have a great weekend, and I hope to see you sometime soon again. Thanks a lot.
Thank you.
Well, just about a minute to go for the markets to shut shop for the week, and of course, we're all waiting for the markets to, call it a day, given the fact that we've seen quite a steep sell-off coming in in the last few minutes. In fact, 25,460, that's where we are at. 25,500 crucial level that's been really breached on the downside. I don't know whether the trend has been reversed, because till now it was a slow drift towards 26,000 that we were trying to reclaim. But this whole AI disruption has really spoilt the mood on the Wall Street, so to say, and we've seen steep sell-off coming in the IT names, and as a result, given the weightage IT has on Nifty, that's managed to drag the Nifty down with itself as well. For today, the swing low was 25,444. That was even below the 25,450 mark, but we've shut shop above that 25,450 mark. 25,458, that's where we've shut shop, 3:30 on the clock. So 350, almost a 350 point cut on the index, 1.3% cut on the index. For the Sensex as well, it's down almost 1.5%. The Midcap index, almost 2% cut coming in there. Breadth of the market, not looking pretty. 1:3. That's the NSE advance decline ratio. In fact, 2:7 if you may. 670 advances to 2297 or 2300 declines on the NSE. Not looking good. Portfolios would have borne the brunt of this weakness. Bank Nifty, it was faring well if you compare it to the benchmark. It has done a little better than the benchmarks, but till now it was showing resilience. Today, the Nifty Bank Index as well saw some selling pressure along with the broader weakness that we've seen in the market. Almost a percent cut on the Nifty Bank Index as well. A 550 point cut, although it has managed to hold on to that 60,100 level as well. So some bit of resilience, but let's see whether it manages to show some bit of resilience next week as well. We'll talk about the next week outlook with our guest who will be joining in just a bit. But let's take stock of the sectoral movers then. Today, IT did okay, given the fact that it managed to claw back pretty smartly from the day's low. At one point in time, the IT index was down 4-5% today as well, but ended the day or settled lower by 1.5%. So, some bit of buying emerged at lower levels, some value buying, you can say, after the kind of hammering some of these names have seen. Metals, metal index was the top laggard today, 3.5% cut. Real estate index was down over 2%. All the sectors ended in the red, but pharma, PSU banks and the Nifty Bank Index, those were some of the indices that saw relatively lower cuts if you compare to other indices. All right, on that note, let me bring on board our next guest. Joining me is Aamar Singh of Angelone. Aamar, lovely chatting with you, but I'm sure the mood would be a little somber. It's deep red across the screen. It's a Freaky Friday, Friday the 13th, and that's really played out in the market as well. 25,450 broken on an intraday basis. How rough could the ride get going forward from here, and what would you anticipate for next week?
Yeah, good afternoon, and thank you for having me. So basically, see, what we are seeing is a major impact on the indices on the back of the IT and the metal space. IT specifically more so. So if I look at the index, particularly if I start with Nifty, we're definitely seeing some sort of consolidation there, because post the budget and the trade deal announcement, we saw a sharp up move, but the high that was made on that day, that hasn't been taken out. So which was somewhere around the 26,340, 350 levels. So clearly, so those who entered around those levels, they got trapped. And from there on, the market went into consolidation, moved up towards again the 26,000 odd levels. And from there, it has corrected. So this is a very sharp move, but more or less on expected lines, because somewhere or the other, valuation concerns and the impact of AI was also being discussed globally as well, and that's what we are seeing that reflect in our in the IT pack. Having said that, if I look at the benchmark index, Nifty, so Nifty on the downside currently it's around 25,400, 500 zone. So ideally, if you see 25,300 to 400 is a very strong support zone, but because that was also a gap which earlier was there from 25,400. it had gapped up. So that filling of the gap is likely to happen, and we could see some further pressure. But on the downside, if you see somewhere around the 25,000, no, 25,200. So 300-400 points down, there is very strong support for Nifty. So we could witness some sort of consolidation, and until unless there's some fresh negative trigger which is impacting the overall markets, like for example, in the metals, we've seen weakness in the metals, and so if we continue seeing that, then that could have a further impact. But apart from the metals and the IT, there's nothing much happening per se. So I would say that we could witness some sort of consolidation. And if I look at the heavyweights, heavyweight Nifty heavyweight, so for example, if I look at Reliance, so Reliance is again very strongly supported at the lower level, somewhere around the 30-50. So the recent lows are something which are likely to be held. If I look at, for example, HDFC Bank, HDFC Bank is some cause of concern because it's taking out some very crucial levels. But again, on the downside towards 880, that's a strong support zone. So what I perceive is that the markets could consolidate but find support at lower levels.
Okay, find support at lower levels. And 25,300, 25,400, I think you mentioned that zone that would form a crucial support zone. Of course, the resistance, moves lower now. Earlier, 26,000 was quite a hurdle because we were trying to cross that level, failed to do so this week itself. Where do you see the resistance placed on the upside?
Yeah, so immediate zone of resistance is somewhere on the 25,700, 25,800 zone. Because what we're seeing is that the short term, if I look at the trend, just speaking about the trend, so the long-term trend for Nifty is positive, but again, that's somewhat flattish. I'm talking about the monthly charts. The short-term charts or the intermediate-term trend, which I see, that is very strongly supported for Nifty on the downside. But again, on the upside, as I said, 25,700, 800,
Sure.
that's an immediate zone of resistance. So any pullback could be sold into, but it's likely to consolidate in this zone, which I've spoken about.
Okay, expect some consolidation going forward. You mentioned the banking names like HDFC Bank that have broken below crucial support zones, but the Nifty Bank per se has shown resilience. Today, was a day when, of course, we saw 1% cut, but thus far, Nifty Bank Index had done pretty well. Any other stocks from the Nifty Bank Index that could be looked at for next week from a trading perspective?
So if I look at the Nifty Bank Index and the constituents, so more or less some sort of consolidation is only being witnessed. I would say ICICI Bank is one stock to keep a close watch on. It hasn't really corrected. It did correct towards 1340, again back above 1400 levels, but it's unable to breach the 1425, 1430 level. So if it's able to sustain above that, then we could see a 4-5% rally in ICICI Bank. So that's one stock to keep a close watch on. And if I look at the other banking names, most of them are witnessing consolidation. I think it's the SBI which is really holding the fort for the banking space right now. The way SBI has been
Yeah.
up, if you see for the current week, it's about almost 12%. So I think that's where, and also some of the PSU banks have also held firm. But the private sector banks really haven't done much.
Yeah, but is it a good time to chase the rally in SBI? 12% as you mentioned, and in terms of market cap as well, it has clocked in that 10 lakh crore market cap. How much more of an upside do you see for SBI going forward? It has already hit 52-week high last week, this week rather.
Yeah, I would say it's see the trajectory. It's like it's on a very strong momentum and roll. So no doubt about it. It did correct towards, if you see towards the budget day, it had corrected almost towards the 1,000 level, and from there it's up by almost 20%. So post the results, and also so if the structure is very strong for positive and positive for SBI, but buying at the current levels, it's a risk reward ratio which really is one needs to keep in mind. But overall, yes, this is a stock definitely on declines, is an opportunity to buy, I would say, because the trend is very strong amongst all the PSU banks or the banking space. And as I said, ICICI Bank is another bank one can keep a close watch on, provided it sustains over the 1420, 1430 levels. And HDFC can be a good buy around the 880 levels if it sustains around those levels.
Okay. Okay, 880 levels, good buying zone for HDFC Bank and all the other banks like ICICI Bank. Looking about SBI, of course, perhaps a buy on dips approach would be more prudent. But let's break it down and talk about IT stocks as well, because that's been a talking point this week. What would you make of the moves in IT stocks today in particular? Because we've seen buying coming in at lower levels, because we saw IT staging a smart recovery, 4% off from the day's low, the names like TCS, Infosys. Does it make sense to go for bargain hunting in these beaten down IT stocks at this juncture? If yes, would you veer more towards mid-cap names? Because even they have gotten hit quite badly.
Yeah, see, if I look at, first of all, I'll talk about Infosys. So, see, Infosys is a very crucial support zone. So if we go back and see, so somewhere around April of last year, it was around from these levels when the stock had bounced back towards the 1700 levels almost. And again, it's from these levels the stock has bounced back today. So clearly, this 1280, 1300 is very strong support zone for Infosys. So what it effectively means is that it's more from a trading play. I would say that expecting a V-shaped recovery in the IT stocks it doesn't really seem likely. And if I look at some of the other stocks like Persistent is also corrected by almost 6.5%. The trend continues to remain bearish. There could be some further selling pressure. As far as TCS is concerned, what we are seeing is that TCS has got, ideally, it had very strong support earlier around the 2800, 3000 level, but this move in the last 2 days has taken it below that level. So it's trying to form some very strong base. So we'll have to wait and watch but one thing is very clear that today's low is going to be very important. And if today's low is breached of Infosys or TCS for that matter, that means there could be more in store for the IT space on the negatives.
Okay, so today's lows, those will be crucial levels on some of these IT names. But they did well to pull back after seeing cuts of 4-5% at the open. Another pocket that saw a lot of drubbing today was the metal universe. Of course, Hindalco was tanking as well on the back of numbers. US business was impacted because of the fire at at its US business, of course, Norwego plants. But talking about the other metal names like Tata Steel and the likes, the ferrous ones as well, what should the approach be? Because it's been a fairly volatile pack in recent times. 2025 was great for metals. Metals provided support at a time when the markets were not doing well. And even after that, we saw follow through buying. And of course, with global metal prices on the upwards trajectory, these stocks also did well. But they have now become vulnerable to bouts of sell-off as well. So, what would be the right strategy when it comes to metals, both from a trading perspective and from an investment perspective?
So, see, if you look at the metals, definitely I would say still, if I'm talking about Tata Steel continues to be strong and firm on the chart. So, effectively, it means is that pullbacks are a buying opportunity. The big question is where do you buy? Because recently, as recent as second week of December, Tata Steel was somewhere around the 160 levels. From there, it rallied as high as almost 210. So that was, if you see, around a 30% rally, which has happened in 2 months' time. So the rally has been very fast, and what's actually happening is that those investors or who would be making losses in some of the other sectors, they would be trying to capitalize on these sectors where they made money. So I think that also would be one of the reasons where we could witness some sort of profit booking. As far as Tata Steel is concerned, Tata Steel has got excellent support somewhere around the 180 odd zone. So maybe a 10% correction from the current levels could be looked as a buying opportunity, but not at the current price.
Okay, okay, that's the thesis when it comes to metals. But there's another stock, Muthoot Finance, of course, a gold financier that was in focus today. Numbers are fairly good, right? Profit saw 95% jump. NII grew by a solid 60% or so. Brokerages have also maintained their buy calls on the stock, but the stock was down 12%. And Muthoot, if you look at the stock over the years, it has been quite a great performer, sparkling performer, so to say. What would you make of today's double-digit move on the downside? And does this present an opportunity to buy the stock?
So if you look at Muthoot, there are a couple of things. You're right that the net profit was excellent, and sales have also been strong. But if you look at the net profit, there has been a provision also which has been made, and also if you look at the acquisition, the new clients acquisition, that is actually slowing down, and also the tonnage of gold which they are loaning, that also is coming down, because I would say because the gold price is also on the higher side, so definitely the demand would reduce there. But overall expectations, markets are expecting that going forward, the growth rate might not be as the way it was in this quarter, and also markets have been discounting, because if you look at the stock has generated, has been a, I would say, a multi-bagger in terms of the way the stock has rallied, and it was a one-way street for the stock despite our markets. If you look at the long-term charts of Muthoot, it's clearly been an uptrend only recently for the last couple of months. So if I go back in January, it had made a high of somewhere around the 4150 odd, and currently it's around the 3500, 3600 level. So that's more of profit booking that is happening. If you ask me about the trend remains strong from a longer term perspective. But yes, the stock, ideally, if you ask me what's a good level to enter, so that would be somewhere around the 3300, 3400. That's a level where there could be fresh entry that could be made in the stock, provided it consolidates around those levels.
Okay, 33, 3400, that's the level to watch out for, and that's the level you can actually look for an entry point when it comes to Muthoot Finance. There were quite a few winners as well when it comes to earnings in today's session. Honasa happens to be one of them. Good set of numbers, highest ever quarterly revenue. Mama Earth also returned to double-digit growth. We saw a good move coming through on the stock prices today. Would you look at this stock, post numbers? Does it warrant?
Yeah, see, if you look at this stock has been an extreme underperformer because of September 2024. The stock was quoting around somewhere around the 550 levels, and from there it corrected all the way towards 200 levels. And so now it's around the 300 levels. So it has bounced back, but still, if you look at the way the stock was earlier performing, so it's still a far cry. So I would say that yes, it seems that the stock seems to have formed a base and has moved up. Today, volumes have also been significant, but somewhere or the other, the stock has got very strong resistance coming around the 320, 330 zone. Currently, it's around 300 odd levels, so that's roughly around 8 to 10% from the current levels. But that's where the stock has got very strong resistance. So if there is an upside move, there it could find with some resistance for any major rally in the stock. So when I'm talking about a major rally, meaning in excess of 20, 30%, the stock would have to sustain consistently above the 330 levels.
Okay, that level of 330, that will be crucial to watch out for on a Honasa. What about Eicher Motors? Good set of numbers, and the stock has been on an upward trajectory, picking up pace. How would you look at some of these two-wheeler names? Because if you compare it with four-wheelers, this year has been much better for the two-wheeler names. Would you look at riding the rally in two-wheelers right now, or would you say that get into four-wheelers after the kind of GST-led up move it has seen? This correction only opens up buying opportunity. How would you look at the auto universe?
So if I look at the two-wheeler space, Eicher Motors, it's been on a roll. We did see some correction earlier happening from almost 7,500 levels towards the 6,600, 6,700 levels. But again, it has bounced back significantly, and it's across the 8,000 mark. So if you look at In the month itself, the stock is up by almost 13% or so. So clearly, what it reflects is that there is a lot of strong bullish momentum and investor interest even at these levels, at record levels, I would say. So those who are long, they ideally should stay put. And if I look at the stock has now got good support somewhere in the 7,400, 7,500 zone. Fresh entry at the current levels might not be very favorable in terms of the risk reward ratio, but those who are long, they can stay long. If you ask me about the trend remains very strong from a longer term perspective. Short term, intermediate term, we are seeing some sort of consolidation, and then we've seen some sharp rally. So rather hold on to the stock till the time we see a trend change or the stock starts trading below the 74, 7,500.
Okay, hold is the call when it comes to Aisha. But another name that is coming to my mind is Bharat Forge. The numbers weren't good, but the commentary was good because they've said that the worst is over. I was just going through some brokerage notes on Bharat Forge. Jeffries upgraded the stock. Target price has been raised to 2150. On the other hand, CLSA also upgraded the stock to hold, but target price is somewhere around 1700 or so. How would you approach this stock? Which side would you, really lean in towards? 2000
So
plus or,
yeah.
17, 1800 bucks?
Yeah, we've been positive on this stock for quite some time because being on the defense side also, that is also helping the stock. And also if you look at the stock from a technical perspective, so on the fundamental side and as well as the news driven side, that's been positive. If I look at the stock from a technical, some of the technical indicators from the long term perspective have turned positive over the last few months. So that and post that we've seen some very sharp momentum, and also what we've seen is that volumes have been extremely high, both in terms of delivery quantity, in terms of the volume. So that clearly shows that there has been interest, and that was somewhere on the 1150, 1160 zone. So from there it rallied towards the 1500, 1560 zone, and then it breached those levels because that was acting as a zone of resistance. So now if I go back in time and see where exactly the stock is likely to meet with a wall of resistance, so that would be somewhere around the 1800, 1810 zone, because that was the all-time high of the stock which it had made in June of 2024. So the stock definitely has a potential to rally, and the way the stock is rallying, it could rally towards, I would say, 1800, 1820 levels. That's going to be a key zone of resistance for the stock. Yeah, if that is taken out, that means the stock is an uncharted territory, and also with the fundamentals being on the positive side for the stock, then the stock could scale up higher towards 1900, 2000 levels. But immediately 1800, 1820 is a level to watch out for. As far as major support for the stock is concerned, that's somewhere
Okay.
around the 1550, 1600 zone. Short-term support.
Okay. Short-term support levels, take note of that. And of course, the outlook on the stock also remains fairly bullish. Exporters had a field day today, right? They opened lower, but I see some of these names like Gokuldas Exports, KPR Mills recovering almost 10% from the day's lows, buying interest coming through. They've had a volatile time, especially after that US Bangladesh trade deal. We saw some bit of selling pressure creeping in. But today they did well to recover from the day's low. Any of these stocks that's catching your fancy? These textile names, Gokuldas, KPR Mills, Vardhaman Textiles, any of these?
So if I look at Gokuldas seems to have found a base, no doubt about it, somewhere on the 600, 650 levels. It has bounced back recently, trading over the 800 odd levels. So it's definitely positive on the charts from a shorter term and intermediate term perspective. So on the upside, sustaining above the 850, 860 zone, it has a potential to rally towards 950 odd levels, where it could meet with the zone of resistance. Because what we are seeing is that most of the indicators from a long-term and intermediate term perspective, they had been oversold because the stock had corrected almost by 50% from its highs of 1200 levels. So with the positive news flows coming in and also volumes being high, that's the reason we've seen the pullback in the stock. So I would say that 850, 860 is a zone, immediate zone of resistance. If that's taken out, then the stock is likely to rally towards 950 odd levels. That's where it could meet with some stiff wall of resistance.
Okay, okay, that's about textiles. But just a couple of more questions. For next week in particular, what would the trade really be? Would you look at trading on the Nifty Bank? How are you positioned for next week?
I would say that one good trade which I had already spoken about is HDFC Bank. So if we see some sort of correction in HDFC Bank towards the 880 odd levels, then that could be a good play in HDFC Bank as well, and also in Bank Nifty as well. So if there is some correction, and we see, because HDFC has a maximum weightage there, so from that perspective, that's a level to watch out for, and that could be a very good play from a short-term perspective, because we could expect a rebound. The other stock which one can look at, if I say, so that's something on the I would say IT space also, because we've seen some correction. But for IT, Infosys is one stock one can look at, but more from a trading play rather than buying and holding, because if I look at the long-term charts from where the stock has bounced back today is one of the major support zones from a yearly chart. So that's the reason we've seen this pullback. So we could expect some further upside move towards, say, for example, 1450 odd levels, but again, it could go in consolidation. So more you have to look at it. So the closer you buy towards the today's low, that would be a better option, but more from a trading perspective.
Okay. Sure. From a trading perspective, those are the two stocks, HDFC Bank and Infosys. Anything from the broader end of the markets, from the mid and small cap universe, that's worth a look at the current juncture, because mid caps and small caps have fared much better compared to benchmarks this week. Any pockets that is that look ripe for looking for trading opportunities, or even a positional opportunity, so to say?
So see, in that space, I would not say mid cap, but if I look at one of the stocks, Bajaj Finserv from the financial space, that's one stock which has seems to have formed a base and is sustaining over the 2000 level. So sustaining above this level, we could witness a 8 to 10% rally in this stock. So that's a stock again to watch out for.
All right, Bajaj Finserv, that's another stock to watch out for. But with that, Aamar, would like to thank you for taking out time and joining in this afternoon. Always a pleasure.
Thank you.
Of course, we are leaving the screens with the deep red on the screen. As I said, it's Friday the 13th, and the street was fairly spooked. First by the AI disruption, and then the crack in metal prices. It's also happens to be Valentine's Day tomorrow, so the bulls have taken it quite literally, and they've gone into hiding. That's the deep red color, because the bears have emerged victorious this week at least. But with that, we've completely run out of time on this edition of Closing Bell. Thanks a lot for tuning in. Stay tuned to Moneycontrol for all your other news and updates, and have a great weekend. We all deserve one after the kind of week that we've had, really. So much news flow to digest. But we'll see you with the markets on Monday morning. Hopefully some buying would come through after the kind of sell-off that we really saw today. Good evening, and have a great weekend. See you next week. Thanks a lot for watching.